Welcome to DigitalK.
Well, I am super excited to finally follow Satoshi on stage at a keynote. So thank you for that opportunity, DigitalK, and a morning of really inspiring content. So obviously this is a blockchain and crypto track this morning. We're talking about a lot of cool things. Luckily, we had a lot of neutral to future talk about security tokens, which is great, because that's actually what even though that's my subject, I'm also in that space of thinking this is something we're going to come to. It's not quite here yet. But to that point, this is actually, I don't believe this is a blockchain or crypto conversation or startup conversation in the pure sense. So that's why I think it'll be fun for us to look at a couple different things on this idea of tokenized securities and the future of investment. So just very quickly, I am not clicking. We're not moving. So there we are, very good. So Andreas this morning talked a little bit about this concept of programmable money, and if we really look at cryptocurrencies in that sense, I think there's a great quote by Anthony Pompliano that really puts this in perspective of this idea of tokenized securities or security tokens, then is the idea of programmable ownership. So we're going to be talking about all the assets that we already kind of think of as investment opportunities, but we're going to look at them differently. My name is Ethan Pierse. Feel free to tweet any of this along and share it with your community. Most importantly, down there on the bottom, it says that I'm not a lawyer and this is not legal or financial advice, so it's always good to throw that in there. The CryptoAssets Institute is a nonprofit think tank based in Paris. We work with governments around adoption and regulation. We work with large corporations on historical business model disruption, opportunities and risks linked to the blockchain economy and crypto assets, as well as with funds around everything that deals with tokenization. And this month we're actually launching CryptoAssets Local, which is a global community of local chapters, basically of people who are interested in crypto assets and blockchain economy, tokenization. We'll be launching with around a dozen or so cities, so that'll be pretty exciting to see once we get that going, to kind of ecosystem build and pull up the value that we're going to see in the future from all of these great technologies, kind of push that forward. And then in third quarter, I have a book coming out with the same title as this talk, Security Token Offerings, Tokenized Securities, and the Future of Investment. If you're interested in that, you can go to ethanpierce.com/STO, and you can actually sign up to get a free digital copy of that whenever it comes out. So diving on in, if we talk about crypto assets, we use the word cryptocurrencies a ton when we talk about these things, but in reality, that only applies to stuff that should be a payment model. And so a lot of the people who are not in this space, they get stuck on the word cryptocurrencies or just crypto in general, and it's really important to understand that there's a larger concept of crypto assets that covers things like currencies, covers the idea of tokens. Tone is a huge fan of utility tokens, for example, so we know that's another great space. And then anything digital commodities, which is what we're going to talk about right now. Digital commodities, things that have an asset linked to them. What is wrong with utility? So this is a huge discussion. I don't want to dwell on it a long time, but I think it's important to explain this to really understand why we have this securities conversation. So utility is this idea that the token actually is going to do some kind of work. It's going to be the fuel of the project in some way. It serves some purpose. Well, most of the regulators in the world that have been tackling this subject are falling on the side of if there is future utility, meaning that the token is only going to be usable later. It can't be used right now at issuance. So I buy that token. I cannot use it today to do something. If that's true, then it's future utility. And in their opinion, in most of these jurisdictions, that is going to be considered a security. What is that? Where does that come from? It comes from this idea in the US of the Howey test, which is not really law. It's more of a framework in the way that they look at this. And it's not, we won't go into detail, but basically if you give somebody money with the expectation that you are going to get more money back, that is an investment that, if it's done in a public way, makes it a security that needs to be regulated by your regulator, the government, like the SEC in the US, AMF in France, things like that. So a security token, why do I use both of these words in the title? It's because I really want to change the discussion to really not talk about security tokens, but to talk about tokenized securities. They are maybe in some examples not the same thing, but more or less the conversation I want to have is, instead of talking about tokens that are securities, I want to talk about securities which are tokenized. And why does that matter? It matters because we already have an infrastructure for dealing with securities. We're not inventing anything new here in the sense of dealing with assets that we already know about and working with these things. So we're just tokenizing them. We're adding we're adding a layer to that lets us work with them differently. And that's what we're going to talk about in detail, is that idea. So just to really explain that in case it's not clear, a security is just a fancy word for a tradable financial asset. It's the word that lets us say this investment that has some kind of ability to be passed from person to person. It's going to have regulatory oversight. We refer to those as securities. Why do we want to tokenize securities? Well, the first biggest thing I think that is really fascinating in this idea is the idea of the democratization. And this is where I'd love to have a panel at the end of today. I would love to have all the speakers back on stage and have like this kind of melee, battle royale around these topics, because I think there's a lot of things we actually agree with, but we're using different ways to get there. I really feel that tokenized securities will democratize access into a lot of assets, a lot of the highest performing assets that if you have small capital to invest, you can't actually get into because you don't have enough. Yet those are the higher performing assets, which means small capital begets small capital, and you need to have large capital to make more large capital. So I think that tokenization, for the reasons we're going to look at right now, will democratize the world's access into all kinds of different assets. The main way that that's going to happen is through fractional ownership. Fractional ownership is this idea that, imagine we have an apartment building, and it has 10 condominiums in the apartment building. You want to invest in one of those. We'll talk about this in more detail in a minute with REITs, but the idea is if the minimum unit of investment is one apartment. Fractional ownership would let us say, instead of 10 apartments in that building, we could divide the building up into 1 million tokens. And now, based on the amount of money I have, if I have $1,000 to throw at that investment, I can get the equivalent number of tokens that represent fractional access. We're going to talk about whether it's equity or whether it's revenue share, but this idea of getting ownership of some value in return, that is a really cool thing, because most people already today in a lot of places don't have enough money to buy their first home, let alone buy an entire second home as an investment, which can be potentially in a lot of cities a very high returning asset. Fractional ownership allows us to take the capital we do have and get access to an idea like that. Next, we have liquidity. This is where most people start to go really negative on the idea of tokenized securities, because they think we need to have liquidity immediately. Liquidity just means that you can move in and out of the asset. So if I buy some of something, I want to be able to get out of it. People who put $5 million into Uber had to wait 9 years to get $2 billion out of it. There was no way in between for them necessarily easily to turn that to recycle that money, that capital, and do something with it. The stock markets exist so that I want to buy some Tesla, or more importantly, you might want to sell some Tesla. But got a laugh from somebody who likes that. The idea there is that with this idea, you can move in and out of the asset based on where you feel the asset's performing, and some people want in, some people want out. Liquidity is that opportunity. And we don't have that in a lot of these asset classes in a very easy way. So tokenization, in the same way that you can sell whatever crypto that you have that you want to pass on to someone else, you can do that as long as there's somebody on the other side that wants to buy it. So the reason that liquidity is an issue is because we don't actually have enough, right now, or potentially even forever in a lot of these assets, enough demand to create regular liquidity. But I believe we will have a lot of punctual liquidity, meaning I want to buy some of the asset you have, like those tokens for that apartment building, and you want to sell them. We can figure out a way to meet together, either through the different tools that will be built, the different platforms. We will be able to find that. And if there is no liquidity, then that will be a problem, but this is about the potential of liquidity, not necessarily the absolute of liquidity. Issuance, the mere fact that we can invest into things in a tokenized way is where this gets really cool. Liquidity will come. 24/7 trading, we heard about the fact that we have one single company in the US that settles all of the equity trades on things like the stock market and stuff like that. That creates lots of issues, one of which is you can wait 2 to 3 days to see the money show up in your account after you sell some stock, because they need to make sure that the transaction could actually happen and all that. If we tokenize that, these things become instant, or practically instant, because computers and the algorithms can take over and do the hard work, and we know that the assets exist and are tradable because they are actually on a blockchain somewhere, and the transaction says that belongs to you, it is available, this is possible. It also will tremendously reduce fees. So we talked about assets, if you have some small amount of money to invest, or medium amount of money, and maybe mutual funds or real estate investment trusts are the way you want to get access to more expensive things. Maybe you want to buy some Apple stock, or you want to buy some Berkshire Hathaway stock. Maybe the only way you can get into those things, because of their per share value is because you have to buy into a mutual fund. Problem is if you're putting a couple $100s to a couple $1,000s a year into a mutual fund, the fees on that fund are destroying any of your gains, which means that the efficiency that tokenization would bring to that creates models where we could create a mutual fund, an electronically traded fund, that allows us access into these assets without having the fees in the same way. Another thing that's very important, shareholder cap. The Jobs Act in the US changed this from 500 to 2,000 a couple years ago, but if you're not a public company, you can only have 2,000 shareholders in your company, which means you can't just let everybody invest. It doesn't work that way. Uber, Airbnb, a lot of the kind of the shared economy ideas have been looking at how they could provide a revenue share or some kind of a dividend return to the people who've actually built their economies, the people who drive the cars, who rent their apartments. The problem is that starts to smack a lot like a security, and if these companies haven't yet gone public, which Uber had not at the point that they were having these conversations with the SEC, then they have a shareholder cap. Tokenization would potentially go around that if the correct laws are in place to allow this kind of access. It allows you to bring global capital. So these are things where most people in the US don't invest on the London Stock Exchange or the Japanese Stock Exchange or anything like that. It usually stays very local. Global capital will let people with the amount of capital they happen to have invest in an asset anywhere else in the world as long as the proper regulations are followed and things actually work out. Automated compliance. Again, this is, without getting into the technologies of the blockchain and how this stuff works, the ability for this to be, the compliance to be automated, but also to have all these things be programmable exists in a really cool way because now the technology can do the heavy lifting. If you want to pay out dividends, every quarter after you've bought into this security token offering, every quarter the smart contract is just going to send you the revenue share that belongs to you because it knows how much revenue is created. It can go find the money from the bank account to then distribute to all the people based on their percentage of ownership at that exact moment in time of those tokens. That kind of programmability creates all kinds of interesting models. And reduced legal expenses are huge because once we deal with this, you no longer have to have humans doing it. We can start to turn it into things that we can cycle in terms of the amount of, we can just mutualize a lot of the effort, which means all of a sudden we don't have to have a contract or a legal structure for every single thing. The blockchain potentially can take over and handle some of that heavy lifting. This is about breaking an asset down into smaller parts, but as we're going to see, it's also about reassembling those parts into new asset classes. So we can divide an apartment building down into small pieces, but we're going to look at how we can actually add those together and create a new asset. Talk was mentioned a little bit about equities. I don't believe that STOs will be really about equity. I've talked around 800 projects since last June in different ways, particularly with the Lithuanian platform that is issuing STOs, but in other places, and none of those conversations were about an equity. They were all revenue shares, which is the main one we're going to see. And that's because when we look at the assets here in a second that we're talking about, almost all of these assets, nobody is going to give up equity in, but they can provide you access to more of a dividend or revenue share potential, which is even more interesting because as was mentioned on the panel earlier, investing in early stage startups from an equity perspective, you lose most of that money. So STOs in an equity sense will probably not be a great way to invest in startups in the early stage. But what are the things that we can be looking at to invest into? How is this the future of investment? The place that we are going to, not where we're at. Don't judge STOs and tokenized securities for where we are because governments are working very hard to create the regulatory frameworks that will allow this to happen and to move forward even at their pace. A lot of this is moving in the right direction. It just takes time. The reality is that what is the future that we are looking for of this? We're looking at blockchain startups, regular startups that aren't really anything to do with the blockchain, SMEs, real estate, intellectual property, commodities, and tokenized investment funds. Walk you through these real quick, just to make sure we're efficient on time. Blockchain startups, we can say 25 billion in ICOs, more or less. Regular startups last year, early stage, maybe around 35 billion in early stage venture capital. SMEs, there is a $1.4 trillion funding gap in Europe alone, over $5 trillion in developing economies. That means small businesses that are asking for money that can't get it to build their businesses. That dwarfs the startup conversation in terms of the amount of money that we need and also the amount of economic impact that could have. Imagine a consulting company in this city that already makes 10 million a year in revenue. With another 2 million, could maybe double that revenue over several years. They can reach out to their economic community. They can find that money. They can tokenize it, provide a revenue share into their growth, and all of a sudden, we're scaling small business without having to deal with the banks, without having to deal with institutional money. Real estate. The St. Regis in Aspen did a campaign last year, for an equity campaign, raised $18 million to provide shared equity into their hotel. We're already seeing this space happen in real estate because people are very excited about the ability to provide access in smaller pieces to more people into assets. Imagine you could tokenize an apartment building or an office, and the idea is very simple. You want to buy that building and transform it. It's going to cost you $50 million. You're going to pay that $50 million. You're going to put another few million into it to change it over, make it better. You're going to sell it for 80, and you keep what's left over. Except you probably had to borrow money from the bank in order to buy the building, which means you don't actually own the asset. You're just making some money in the middle. If we tokenize that building, you can actually get all the people to give you money to buy the building. You own the asset, and now they will get a revenue share when you commercialize the building. This gets really exciting really quickly. We have that in real estate investment trusts, but again, the fees and some of the structure issues are not terribly efficient. Very quick on that, imagine if I bought 10% of 10 different buildings tokens. I create a fund. Now you can buy into my fund, and you have access to the real estate of a city across multiple buildings in a tokenized way. You could go long on Soho and short on Tribeca if you were investing in a real estate in New York City. That gets pretty cool pretty quick. Intellectual property, and I'm almost done. Patents, movies, music, art. So portfolios of patents, that's a huge thing that we can tokenize, the fact that there's lots of IP out there. Who doesn't want some Avengers tokens, some Harry Potter tokens, some Beatles tokens, Mona Lisa tokens, the ability to take these assets and commercialize them. Michael Jackson was worth more because he owned part of the Beatles catalog than for his own music. Film producer Ryan Kavanaugh, yeah, I know, I'm out. Film producer Ryan Kavanaugh last week announced he just raised $100 million for a tokenized security fund for films, and he has created over $17 billion in box office success. This is not somebody doing this because they think it's a fad. They think it's the future of how they can finance what they do. So the last things just to talk about as we end this, catching up, and then we're done because we don't have enough time, is why is this democratization? Because it provides retail access. You do not have to be an accredited investor or an institutional investor in all these jurisdictions. Eventually, this will provide a way for people who are non-accredited to invest into high-performing assets. That's going to change the world of finance and the world of investment.